Good morning, ladies and gentlemen, and welcome to our annual conference, this year in a virtual setting. This morning, our aim is to help SMEs navigate their businesses through the uncertainty that is now part of our daily lives. Since March 2020, Irish entrepreneurs in the business community have shown great agility and diversity. We have all adapted to a changed environment in which we conduct our businesses. Our government have been to the forefront, making over 16 billion available in supports, such as financial planning grant, business continuity voucher, restart grants, TSSS, ESSS, and CRSS. During the past year, we at Paul O'Donovan and Associates have expanded our service offering to become mentors on the EI and LEO boards. This allows us to be at the forefront to advise and assist our clients avail of the various grants and supports for which our government have made available. We are also working with our clients in conjunction with the Revenue Commissioners in warehousing of tax liabilities and putting instalment arrangements in place. The past year has also seen increased funding activity with the Strategic Business Corporation of Ireland, where we've assisted our clients apply for many loan facilities such as Future Growth Loan Scheme, COVID-19 Loan Scheme, and Credit Guarantee Scheme. We have also worked for our clients with the main pillar banks, obtaining moratoriums and additional finance. For those clients who continue to grow, evolve and merge, we have access to funds not only through the main pillar banks, but we have also obtained finance through alternative funders. To date, we have successfully secured government supports and loan facilities in excess of 20 million on behalf of our clients. Our response to the pandemic, our focus on key services for clients, and the dedication of our staff towards our clients throughout 2020 culminated in Paul O'Donovan Associates winning Advisory Firm of the Year, SME Finance at the Irish Accountancy Awards in November last, an accolade which we are extremely proud of. I take this opportunity to thank all my staff for their hard work, dedication, and support in making this all possible. Our team has been fantastic in adapting to working between the office and remote working. We have embraced technology and we've accustomed ourselves to Microsoft Teams, Zoom, and Skype to engage with our clients and other businesses. 2020-21 has been most difficult time, but there are rainbows ahead, with the vaccine rollout taking shape and the government announcement of 405 million revitalised funding for Cork, which will see employment, housing and redevelopment of our city. In finishing, we must not forget our frontline workers who continue their unselfish endeavour to deal with the COVID-19 pandemic. We will forever be grateful for their efforts. Our lineup today is full of high-profile speakers, and on my own behalf, can I sincerely thank Jim Barry, Alan O'Dea, Mark Flood, John Mcinerney, and John Finn for giving up their time this morning to speak to us and share their insights in navigating their business through uncertainty. I hope everyone enjoys the morning. There is a Q&A tab at the end of the screen to post questions to our speakers. There is a chat box for you to post comments, and we will also be happy to discuss any matters with you after the event. For those on Twitter, our hashtag is #CorkSMEEvent. I hope everyone enjoys the morning. Thank you. Now I'd like to introduce our keynote speaker, Jim Barry. Jim Barry is the Chief Investment Officer of BlackRock Alternative Investors and Global Head of BlackRock Real Estate Assets. Jim, thanks very much for attending the event this morning, and I look forward to hearing your comments.
Thanks, Paul, and good morning, everybody. Delighted to be here, and congratulations to Paul O'Donovan Associates on their glittering array of awards in recent times. I know that is well-deserved because Paul keeps telling me how well-deserved they are. Listen, I'm going to maybe touch with a few macro observations, just generally on the economic climate as I see it. Then I'm just going to pick up on a few, what I see as major structural shifts on the way, which I think impact all companies of any size. And, you know, hopefully speak for sort of 15 minutes plus or minus, and then open it up to Q&A. I'm very keen to take questions from you, the audience, and panelists as well, obviously. So the first observation, we're over 12 months into it here in Ireland. It's over 15 months globally speaking, but the pandemic and its consequences, you can lose perspective on how unprecedented what we're experiencing is. And I think it's not just in terms of the pace and scale of the impact of the virus and the associated pandemic, but it's also just the pace and scale of the response by policymakers globally, particularly on the monetary, but also the fiscal side. And I think that, it does put us in a truly sort of extraordinary place. And I think as we think about kind of coming out of this sort of phase of extreme economic slowdown, I think there's a huge amount of uncertainty and challenges, and I'll talk about some of that. But I would say, speaking here in March, it's still all about the virus, and in particular now it's all about vaccination. It dominates. Clearly, some countries doing it better than others. The UK and the US ahead of the EU, for example. But certainly there is real momentum now, and I would say to you that over Q2 into Q3. I would say at a practical level in most developed economies, we will get to sort of that herd immunity you hear spoken about. And that's going to be critical with respect to getting mobility back in the economy and getting economic activity restarted. And in effect, it's almost like the global economy is like coiled to sort of launch itself, not unlike a 100-meter sprinter just waiting for the starting gun. It's going to be a massively powerful restart. Just to give you some context for that, if you remained employed, earning money, you have savings. You have not been spending as you would have had in previous years. And so the scale of that excess saving buffer is about 12% of annual consumption in the US. It's about 8% of annual consumption in the EU. And that is just going to get unleashed as mobility comes back into our economies. Overlaid with that is just the sort of scale of economic stimulus, essentially, both monetary and particularly fiscal. And Paul touched on it in his introduction around some of the very specific measures available here in Ireland. But just to give you context again on that, in terms of the economic loss of this pandemic, put in the context of the global financial crisis only sort of 12 and 13 years ago, it's about a quarter of the economic loss. So this was much more akin to the economic impact you see of a natural disaster, an earthquake or equivalent, where there's a massive fall off in economic activity immediately, but then there's a very dramatic recovery. This is in contrast to a more classic economic recession. And the economic loss that's estimated by economists with a fair degree of consensus, it's about a quarter of the economic loss of that we faced in the global financial crisis in the first few years. Give you a scale of that, in the United States, GFC accounted for about 12.5% of GDP in terms of 50% of GDP economic loss, where it's about 12.5% the pandemic. In the case of the EU, the economic loss of global financial crisis in the first few years is about 125% of GDP, enormous is the impact, where the pandemic's about 25%. The complete flip is that the fiscal response and associated monetary response is about 4 times that in the global financial crisis. In the United States, it was about 3.5% of GDP back 11, 12 years ago. It's over 18% here, and that's before the extra $3 trillion that the Biden administration is now talking about with respect to infrastructure and related areas that they're proposing. In the EU, it's 2.5%. It's now 10% in the pandemic. And so you just got to understand that weight of money, that weight of liquidity is going to have a massive impact on this sort of bounce back. So it is a case of buckle up for 2021. But it is a rebound, not necessarily a recovery, and I'll come on to talk about some of the challenges as we go into 22 and beyond. And then the final thing before I hit on some of those points is just getting back to the virus. I think the pace of vaccination is going to be critical in terms of how quickly various economies bounce back. I think policymakers are getting their head around that, hence the kind of tension you see around issues like vaccine exports that are playing out in the EU today. And I think there's tension with government policy around lockdown. I think that there will be real pressure on to create more relief with lockdown measures as the more vulnerable in our community get vaccinated. And so I think you'll see that play out here in Ireland in the sort of April, May timeframe. And then as we look a bit beyond that, we're only as good as our weakest link from the point of view of dealing with this pandemic. And so as long as there are countries, emerging markets, developing markets in particular, that are not vaccinated, we're still vulnerable. There will be in particular huge sensitivity around mutations of the virus that potentially invalidate the vaccines we just had. And then there's already uncertainty as to how long they last, in a sense. And so I think that that's going to continue to be a kind of an overriding dynamic. It's not a sort of an on-off switch with respect to this pandemic. And I think in particular international travel, I think much to my disappointment, will remain constrained. On audio. Let me deal with a couple of dynamics around sort of structural shifts I see as I look out into kind of 22 and beyond. I'm going to touch on four things before handing it over for questions. I'm going to touch on inflation, which is now back on the agenda. I'm going to touch on climate change, sustainability more broadly, but particularly focus on climate change. I'm going to talk about globalization, or actually deglobalization, as I think we're now looking at. And then finally, I'm going to pick up on one of the consequences of the pandemic is my view is just the utility of space and how we use space and what implications that might have. So starting with inflation, inflation is back and we're going to see it this year. I think you're going to see it on the back of the rebound. You're going to see it on the back of the supply-demand mismatch with commodities, other dynamics. All of that's going to sort of bring inflation levels up quite high this year as against historic norms, particularly in the Western Hemisphere, up around sort of 2.5% plus or minus. But I think as we look into the medium term, it's more nuanced. I think that you will see the dampening effect, I think, of unemployment and the availability of labor as we go into 22. And there's the other scar tissue from this pandemic, in particular in terms of business failures, which will flow through. And I think some of these structural shifts I'll touch on too are also creating disruption. So that'll be a dampening dynamic. But along then in turn, I think that ultimately sort of fiscal gravity returns to governments in terms of their budget deficits. And that has implications potentially for taxes and reduction, which would increase, and expenditure, which will reduce. All of that are dampening dynamics around inflation. But on the flip side, I think that there, kind of the deglobalization, which I'll come back to, will I think be an inflationary dynamic. If we ride through on the back of all this fiscal and monetary intervention, we may not see that sort of the scar tissue as dramatic an impact. And just that continued scale of monetary looseness will again just certainly enable inflation in a way it hasn't been heretofore. And I would say to you that the central banks are taking a benign view, hence why all the signaling is around keeping interest rates low. That's in order to ensure that there's no sort of premature sort of killing of recovery, for want of a better description. But I think it's also so that all this debt that has been raised in developed markets, it's risen to a level of 140% of GDP average, not seen since the end of the Second World War. So that has to be paid back. And so central banks are very much basically helping fund that by keeping interest rates low. Because the effective cost of that debt is even less, it's about a third less than the cost of 120% of GDP that we had post-global financial crisis. The markets are taking a less benign view, hence why you've seen the long end of the curve increase, with some of that putting pressure on equity markets. So there's a real balancing act being played by the central banks here, who are going to remain massively central to our economic lives. And in particular, they have reduced they change fundamentally their inflation target. It's no longer an absolute point to be focused on, it's an average. And so they're going to be much more open to let inflation run while keeping interest rates low. And there's a tension in the mix of that, particularly around control. So expect inflation to be on the agenda as we look out into the medium term as a key economic driver. Climate change. So the issue of sustainability has got huge momentum from the pandemic. It was there anyway. And as an asset manager, I will tell you, this will be probably one of the most sort of structural influences on asset management over the course of the next 10, 15, and 20 years. And in the midst of that, you've got the whole environmental dynamic with climate change, the big factor. And in a sense, what we've experienced with the pandemic, in contrast to global financial crisis, where on the back of the scale of the economic disruption, we had a lot of emphasis taken off issues like addressing climate change. I think it's the complete opposite here. I think what we've seen is with the virus is something existential to our economic and financial systems have this massive impact on the financial economic systems. And so climate change is just that, but on steroids. And the reality is we are going to run out of our carbon budget to keep us to 1.5 degrees centigrade. We're going to run out of that carbon budget by 2028. We bought an extra year with the pandemic. The carbon budget to keep us at 2 degrees centigrade, scientists estimate, will run through that carbon budget by 2051. So there's a couple of key points around that. The first is we will be dealing with climate change. So as you think, and particularly about real assets, infrastructure, real estate, we're going to have to build our real assets to accommodate the implications of climate change, which means more frequent, more extreme weather events. We're going to deal with much more variability and volatility in temperatures, in moisture, in the way it forms in different parts of the world, including drought at one end of the spectrum. We're going to have to deal with then the consequence of that, whether it's flooding, fires, whatever it may be, and the consequential cost of that on property and life. And so this is a real dynamic. We're going to have to invest massively to mitigate the impact of climate change, particularly with respect to rising sea levels, where there's so much activity, economic activity centered around major cities on coasts. And so this is something, as you think about your own businesses, we're going to have to invest to mitigate the impact of climate change. In addition, then we're going to have to invest to decarbonize the global economy. Now, if you're in the energy and power space, you've got this already, because already we're seeing a bifurcation in returns between anything that has fossil or carbon exposure as against stuff that is carbon free. So, for example, the returns on renewable power have dropped materially as against the returns required to invest in fossil, oil, gas, etc., have increased significantly. So the cost of capital is increasing for fossil, but also the quantum of capital available for fossil is dropping off significantly. And that's only going to accelerate, which is only going to effectively drive this transition on top of all the government policies we will see around it, of which obviously this week we've seen our own Irish government policy published. And I think that that is significant for everybody. If you are an energy and power company, you've got it, because it's existential to your business and you have no choice but to begin addressing it. I think if you're very consumer oriented, you're already seeing it too, because your consumers, your customers are basically pulling you in that direction. But I think most companies, while acknowledging it's there, haven't quite internalized the scale of change that's coming at us. It's going to fundamentally impact every value chain, every supply chain, doesn't matter whether you're the largest corporate in the world or a small SME. And I think you need to begin getting your head around that. And also, I wouldn't be buying anything at sea level on a personal or institutional basis. Globalization. Globalization hit a peak at about 30% of global GDP about sort of 11, 12 years ago, around the time of the global financial crisis. Since then, it's been quite volatile around that level, but really hasn't dramatically increased. And I think what the pandemic has done has just accelerated some dynamics around it. In particular, moving from sort of a just-in-time sort of philosophy to more of a just-in-case philosophy with respect to your supply chains. We've seen massive disruption last year, but also you've seen massive insecurities around areas like pharmaceuticals, vaccines, etc. And I think as we saw today, this week with the announcement by Intel, we're going to have much more nearshoring, onshoring of investment. I think that's going to be really good for Ireland, particularly with respect to American corporations. But certainly, we're going to see very substantial shifts and change. We're going to see a bipolar dynamic to it. There is no question the emerging tension between the United States and China will again dominate that globalized world of ours over the next sort of 20, 30 years. And there's going to be a real tension in it, in contrast to the sort of, kind of the old Cold War with the Soviet Union, in the sense that dealing with issues like climate change are going to require broad cooperation. And I think that so there'll be a requirement to deal with something like that common good, carbon dioxide in our atmosphere, but at the same time, real competition for influence in Southeast Asia, real competition around trade, real competition in particular around technology. And I think that either as an investor or as a company, if you're global in your orientation, you're going to need to think about how you play both sides. But it's going to become very bipolar. And whether you're a country or a company, large or small, you're going to have to factor this into your thinking. But certainly, I would say to you, so deglobalization in the sense that the relative weight of global trade in the overall economic mix will certainly not grow and more likely decline over the medium term. And finally, before I hand over for questions, I would say, we've just had the most massive social experiment with respect to, kind of human society, for want of a better description. There were things that we've adapted to and have done, particularly in business, just wouldn't have been contemplated without the pressure and strain of the pandemic. And I think one of the key areas comes down to the utility of space. Now, I don't buy into the end of central business districts. I think for a whole host of reasons, we will want to have people back in the office. We will want to have people working, collaborating, engaged with each other. But I don't think it'll be anything like the scale and level it was, particularly in the major cities where there's such a high cost to commuting, for want of a better description. And I think you're going to see much more of a hybrid dynamic to that with, I would say to you, kind of that mix of a few days in the office a week rather than 5 days in the office a week, much more flexibility for the individual, yet keeping the office as essential. But that means, what does that mean for space in the office? I probably need less space per individual, but I probably need, I need less space because the number of individuals are down, but I need more space per person. It also probably means I need more space at home if I'm going to be working from home more. So this has broad implications and real negative implications in my mind for the commuting ecosystem. Think of all the economic activity tied to commuting, the servicing of the commuter from dawn to dusk, big implications there, and a shifting of that expenditure probably into the suburbs and where people live. So with that, why don't I pause and go back to you, Paul, and happy to take any questions. You're on mute, Paul.
Thank you, Jim. Very informative discussion there. Thank you. Question coming in is, what's the opinion in inflationary recession in the next 3 years and this impact on medium-term interest rates? And do you think these events are a foregone conclusion?
So I would say back to the observations I made when talking about inflation, I don't think anything's a foregone conclusion because I do think there are conflicting dynamics. I would say to you from an interest rate perspective, as I look into that sort of medium term, I expect them to be held low. I think central bank's posture is unambiguous. They want to keep the interest rates low, and they will use all the tools, of which they have an extensive set of tools available to them, to keep them down along the curve. They don't mind it rising a bit from where we are, and we've seen obviously US rates rise above 1.5% at the long end of the curve. But I think as that gets above 2.5, I would expect significant central bank intervention to keep them low. So I think the reality is, I would expect low for longer will persist with respect to interest rates. Now, that doesn't mean that that inflation will stay low in that context. And I think that, and that's where the tensions play in, because I think that, and I'm probably more cautious than the average in the sense that I think there will be real scar tissue from this pandemic that's hidden by virtue of just the tsunami of fiscal intervention that will begin to unwind after the big spurt we'll get in Q2, Q3, and into Q4. 2022, I think that will be more back to normal, and then I think we'll begin to see how real the damage is from this pandemic. And I think I'm probably more cautious on that front, and so that'll be deflationary and counter to growth. But at the same time, you know, kind of the fiscal intervention will flow into 2022. So that'll be there. The interest rates will be kept low, and so you'll have all these positive dynamics as well. And so how that plays out, it's hard to say. I think most economists are predicting, you know, a reasonable level of economic growth at or around potential. You know, let's call it in the United States more like 2.5% plus or minus. And I say that's probably the base case perspective. But interest rates will stay low, but I do think there's a downside risk around inflation and
And finally, Jim,
any other.
as an avid Munster fan, do you see any chance of CJ Standler being returned to South Africa with a Pro 14 medal?
So, being a Munster fan, I'm the eternal optimist, Paul. And so I go into this weekend cautiously optimistic that we pull it off. I think we've been on an upward trajectory. I'm very excited about Joey Carberry actually lasting a match. And bringing more dynamism to our offense. I think our pack are competitive. I think Leinster are down a few key players, and I think just we're on a positive trajectory. So, and I think they'll be up for it. I think they'll be up for it because it's been long enough since we've beaten Leinster, and I think we came damn close in our last game. We'll be up for it. I think that CJ Standard dimension adds to the emotion of the day. It's a shame we won't be there to roar them on, but I'm going to go for a Munster win.
Thanks very much, Jim. And thanks for giving up your time this morning. Really appreciate it.
No, delighted to participate. Thanks, Paul, and good luck with the rest of the day.
Thank you. So moving on from Jim, our next is a panel discussion around funding. And we've two keynote participants, Mark Flood, who is co-founder of Renatus Capital, and Alan O'Dea is an associate director in Beachbook Capital. Welcome, Mark and Alan, and thanks for coming today.
Thanks, Paul.
So getting into it, can you tell us about the additional funding options available to SMEs over the last 12 months? Mark, will I start with you?
Yeah, well, I suppose you've got your debt, equity, and pandemic, and I think you missed a trick yourself, Paul, because your emails on the available supports was probably the most read emails, definitely amongst our finance directors. So you should have gone subscription with that, and you could have made a fortune, I think. So I think like the supports are well documented genuinely on the way you've articulated them, and all your emails are fantastic. But it probably more, there's an evolving landscape of alternative debt and equity. You know, there's never been as much money in the market, and that's, you know, there's so many brass plates around Cork, Dublin and beyond that are investing in Irish businesses, and that's, you know, that could be an alternative debt product 5%, it could be a higher percentage debt product, it could be equity minority, it could be equity majority. And to be honest, I think Alan will vouch for this as well with me. There's so many, every month there's a new fund. So I think it just speaks more and more to the need for a good advisor, because it's like a doctor who'll prescribe what's needed. There's so many different options and there's so many nuances. And in fairness to you, Paul, you're tuned into them all. And I think it's really, if someone wants a kind of a passive minority partner to sit in the back and do it, there are plenty of funds there. If someone wants a really hands-on majority, someone who kind of help them lead their succession or lead an acquisition, that's a different type of fund. So but the one thing is there is a plethora of options now beyond traditional bank financing, and we wouldn't do them just on trying to cover them all. So I think it's really about marrying the personal goals to what the offerings are.
Alan, do you want to comment on that one?
Yeah, no, I'd agree with Mark, certainly in the sense that, from an advisor perspective, when a business is seeking at a stage to take on external capital, whether it's private debt or private equity, it's probably the most significant funding decision to date for that business. It's potentially transformational in their growth story. Therefore, we always advise, it's critical to establish, what your business plan is, what your capital requirements are over the next number of years to meet that business plan. And ultimately that will dictate what type of capital structure is appropriate then for your business at that time. And that will enable you to identify a range of sources, whether it's PE or whether it's private debt or traditional bank financing, and you'll identify the right source at that time for your business. So I think I definitely agree with Mark there that, seeking advice on that process is critical, really.
Another question, how does an SME access this alternative funding, and how does it differ from traditional banking? Alan, will I start with you on that one? Yeah,
so I suppose the first point around how it differs from traditional banking, and I'll just allude to private debt here. We play a part in the funding ecosystem. We're not necessarily competing with private or traditional banks, and we're not competing with private equity. We all play a part, and we're specific for a certain business at a given period in their time. And what I mean by that is, if you look at a business in its life cycle, it initially uses potentially venture capital or early stage capital to get the business to a certain stage where it's then generating a sustainable level of revenue and profitability, but may seek to embark on the next phase of growth. And that might be organic or it might be through acquisition. And that's the role then that potentially private equity or private debt can play a part in supporting that growth. In terms of differentiating from traditional banking, there's probably a degree of flexibility within that realm of funding, of alternative funding sources, whether it's around, the types of the use of funds, it could be for a range of reasons, maybe grow capital for product development, grow capital for international expansion. It might be some sort of shareholder realignment that will free up to get the balance sheet and ultimately provide a catalyst for the business to embark on that growth. And likewise, the risk profile of the business is potentially in the realm of alternative funding. They may be higher, from a leverage perspective, and the dynamics within the market that they're operating, etc. So those are kind of the areas that I suppose we would differ to some extent to traditional banking. And if you think back to the last 12 months, both Renatus and Beachbook have been very active in the market. And that's because we're able to look at businesses from a long-term perspective. Just briefly on the Beachbook, our Irish fund, we structure our senior loans so that they're 5-year terms, non-amortizing, interest only. And the purpose of that is so that we're aligned with the growth opportunity within the business. We feel that a 5-year term provides adequate time for the business to actually execute its business plan, achieve its return on invested capital. And likewise, the interest only element is ultimately to allow the business to reinvest the free cash flow in the business and accelerate that growth. So I think the alignment of interest with the business owners, the flexibility in how we can support businesses which has been evident in the last 12 months. They're probably the key areas where we would differ from traditional banking.
Mark?
Yeah, I think traditional banking, like the banks aren't closed, but they're rigid and black and white in a lot of ways, and it is getting to a point where, you know, a lot of times computer says yes or computer says no to a certain degree. So at a simple level, if there's no asset backing in the business, at a very simple level, they'll probably look at your definitive de facto last 12 months profit and give you 3x that in senior debt. That's kind of the de facto offering by the bank. That can be boosted if there's asset backing, if there's contracts signed, if there's a lot of recurring, et cetera, et cetera. So like the banks, you kind of know in advance what you get from the pillars, and then the myriad of options in between. Then there's a kind of an offering between traditional pillar bank offering and equity, and that's, you know, as Alan is supplying as part of the offering, and others, and they will take more of a view. And again, it's all about aligning. There are plenty of case studies where people took that offering, didn't dilute, and it allowed them get to the next level, if that was to do an acquisition, if that was to fund working capital growth, etc., etc. Equally, there are some that they took it and they probably could have taken equity, you know what I mean, and vice versa. There's people who took equity and maybe took it when they could have took debt. So again, it's all about the right instrument for the task at hand, and hence again the need for very careful advice. But in summary, I think the banks are open, but you can probably predict in advance of going in, Paul, what you're going to get, and then you've got equity at the far end, and then you've got a hybrid in the middle. But you just got to definitely marry it to your needs.
I think, Mark, to add on that though, it's and Paul, we've mentioned this before, you know, it's not necessarily a zero-sum game either for a business. You know, it could be a mix of debt and equity. From a strategic perspective, that is the right choice at that time in the business. But the important point is establishing exactly what the capital structure you require to meet your needs, and that will dictate then the choice of funding.
So just moving on then to, what are the main benefits of this funding for SMEs, and what value can equity bring? So if I put that one to you, Mark.
Yeah, I think equity is a marriage, you know, so I think hopefully all of us and many of us are better off for marriage. But some people, you know, may say they prefer to stay single, and that's equity is a marriage. You're letting somebody in, you're letting somebody into your home, so it shouldn't be taken lightly. And oftentimes people just look at the percentage equity and don't look at the composition of the partner, if you like. So it's very, very important to look at that. So I think the obvious place for equity is if there's an absolute sell-off and someone needs to buy a business for, call it 5 million, and the bank will give 3 million, and you need 2 million, and there is an equity gap. Like, that's the kind of obvious one that people think about. But probably where we're playing an awful lot at the moment in Renatus is giving people some chips off, which it moves them away from this binary decision where they have 100% of their wealth stuck in a company, and but yet they don't want to sell it. So selling it is a bad result, and keeping 100% of their wealth stuck in one company that anything could happen, as proven last year, isn't optimal either. So getting so what we've, you know, particularly, we can't speak in detail about some of our deals, but probably our last two had that composition where we allowed both parties some money off, and it just allowed them monetize some of the success and really go for a new 5-year plan. So that was there. And the second area is to facilitate acquisitions where debt, you know, they do want to grow and the business is growing. So debt only just doesn't work, in the sense that there needs to be a composition of equity to flank the debt. And as regards value add, I think from our perspective, we offer 5 layers of value add with our money, and thankfully all of our partners would attest to what we bring, and we'd encourage anyone when we're funding to talk to each and every one of our partners. And there's ourselves, like we've run businesses ourselves, so we have empathy for what happens. And if there's a tender going on and the board meeting's the next day, we'll skip the board meeting, or we don't mind if there's no papers. You know, we've lived the real world, and we're not just kind of living in a laboratory thinking that there's no germs. There is, and we're empathetic to that. We've a young team who help if it's on tenders, if it's sourcing acquisitions, if it's sourcing banking, if it's whatever else. There's massive support with our kind of young McKinsey type team on many areas. Our investors, we're 80% privately backed by high net worths, and they love SMEs. We've probably 4 CEOs of PLCs. They just love SMEs and want to help, and that's been an amazing help in many companies, opening doors for contracts, for deals, for expertise. And that's a big value add that we bring with the equity. And fourth of the fifth is bringing functional expertise. So if it's SMEs, kind of oftentimes need expertise in HR, in operations, in finance, in digital, in marketing. And we've spent a lot of time meeting a lot of people that we can infuse in for maybe a day a week or maybe a 3-month term, because an SME can't afford a 200 grand person in every function. And generally the founder and the MD of the SME is all of those functions. So they don't respect somebody at a lower level, and rightly so, because they wouldn't shine the shoes of the MD oftentimes. So we infuse that kind of functional expertise along the way. And finally, we bring in co-investors who, be it they may sit as a chair, they may sit as a non-exec, they may sit as a silent shareholder, or they may even come in as an exec, which we've examples across the 5 companies we have where we've done it each time. And that co-investor then brings a value add. They've done it before. And so like in the case of Boojum, we brought the head of retail for Paddy Power when we'd only 5 stores, came in with us as a co-investor and brought a lot of that excellence to it. In Simtech, we brought the head of an airline. It was a pilot training business. In Renix, we brought in an MD who's co-investing now. In Capture, we brought in a lot of people who are well networked internationally to the Stadia and racing game that are going to add a lot of value to that business. And likewise in CRS, we brought in John Fitzgerald, who ran a manufacturing company that was 10 times the size of CRS when we got in. So he's added a lot of value there as well. So it's bringing that. So there's a lot of value add to be brought with the money. And I'd say that, and it's not just Renatus, or it's not just if someone's looking for $500,000, it's kind of don't get it off just the cheapest bidder. See, does someone come with the money and expertise? You know, I think that's a big thing when you're running what I would say is when you're looking for equity or financing, you know, treat it as a tender, but don't put every marks for price. You know, put it for the value add and chemistry and what people can bring.
Couple of questions coming in, Alan. What's the typical timeline for a loan decision from Beachbook? Banks normally can take months before credit approval. Are you quicker? And the second one would be, and aligned to it, is on the personal guarantees on loans. Do alternative lenders also seek personal guarantees?
I'll answer the second question first, Paul. It's direct. We don't take personal guarantees, or the security that we look for in a business. It's just it's a conventional floating debenture. You know, it's back to the whole alignment of interest with the business, you know, where the risk for us day one is the same risk that the business is facing in terms of executing its business plan. So there's a key alignment of interest there in a fund like Beachbook. And then in terms, sorry, first question again, sorry, you might repeat that.
The length of time it takes.
Yeah, I think that, I suppose the first thing to comment there is we are quite responsive, and you know, we're an SME in our own right. You know, we were established over 12 years. The firm is still managed by the two founders, so we completely understand the nuances of SMEs, especially the challenges when raising financing. So we are quite responsive. There's no fixed investment committee once a month or anything like that, but that's ultimately dictated by the level and quality of information and the advice that's being provided from the company when seeking that financing. So we can be as responsive as much as the information is available.
How has the alternative funders supported their portfolios, and if any issues encountered throughout COVID? if you take the Boojum scenario now where they've been rocked because of COVID, Mark, you know, what have you done to support that investment?
Well, I think probably the biggest, like we really came in very early and had daily meetings with the guys, and we're banking through. If you think of the banking relationships, generally you've got retail through the front door, you've got business banking at a level, and you've got corporate at a higher level. But we had banked out of corporate for our businesses because of our group buying power, so it allowed us very, very quickly renegotiate our terms with the banks, particularly for Simtech, which was in aviation training, and Boojum, which had lost 80% of its sales overnight. So we really got in quickly, and meant that we could renegotiate with the bank very quickly to avoid any covenant breaches and get ahead of the game there. And it just allowed us kind of park up, and we had available extra funding to put in, which we put in some into Simtech just to keep the oxygen in the business. And yeah, so it was, we acted quickly, but it used the relationship that we had at a group level as well from a banking perspective, and put money in when it was required.
Alan, would you have a comment on that one?
Yeah, so I suppose, you know, in terms of the general liquidity supports, whether it's around payment interest breaks, etc., you know, we absolutely will provide that where necessary. And you know, we've also, throughout the last 12 months, where required, we've also facilitated additional financing, whether it's SBCI funding or grant support, etc., to help the business. And likewise, if it's required to provide follow-on financing, we have the ability to do that also. In terms of just general kind of, I suppose, as I mentioned, Beachbook is a European fund. You know, we have over 70 portfolio companies at the moment. And in normal trading conditions, we try to facilitate our portfolio companies to leverage off that network, whether that's for advice about entering into new markets or potentially cross-selling or upselling between countries, etc. But it's actually been very useful as well through the last 12 months. In terms of finding solutions potentially for supply chain issues or alternative route to markets. And so we've been proactively engaging with our companies from back in the beginning of March, and providing that support and advice when necessary. We view, albeit a debt fund, keeping with the alignment of interest, we view it as a partnership. So if we can facilitate in any way in getting a business back on track, well, then we do that.
What does the future of banking look for SMEs? Within the next 10 years, what will be the main source of funding?
You want me to take that one?
Alan, yeah, I'm going to take that one. Yeah.
Well, I suppose if you look at the private debt market and the alternative funding market in general, since 2008, when we saw increased regulatory changes and capital controls, there was a reduction in liquidity in the marketplace and this was particularly felt in SMEs. So we've seen substantial growth in the alternative funding market in the last 10 years. Now, the US, North America still, accounts for a large portion of that. Europe is catching up. But I think in terms of the Irish market, I think we're still relatively, it's early days. It's encouraging the last number of years to see an influx of alternative funders. But I still think the SME market needs to be educated further about the benefits of alternative funding, whether it's private debt or private equity. And that's obviously the benefit of these events like today, about educating the market. But to be honest, I think if you use the baseball analogy, where there's nine innings in a game, I think we're probably only in the second or third inning in terms of alternative funding becoming a mainstream source of capital for businesses. So I think there's a lot of market share to be gained over the next 10 years for that sector of the market.
Mark, the pandemic is a once-in-a-lifetime event, but many companies were unprepared, and some Irish family businesses never considered a sale or taking on equity or debt for growth. So have you seen in the last 12 months companies more open to taking companies like yourselves? And is there a change in the Irish family business ethos in relation to that blood as equity?
Definitely, and I'm not saying that I'd have data to support it, if you know what I mean, in the sense from our pipeline. I think a few things, two perspectives. One is, obviously very few people were immune from being affected in some way in the global financial crisis in 2009, 10, etc. And I think last April people said there's deja vu here. Thankfully, people still are very affected in a lot of different sectors, but it hasn't been as bad as maybe everybody thought it would be last April, and particularly helped by some government supports. So I think there is a kind of a few right now. Let's see what we do about this, where we've got all our eggs in this one basket, undoubtedly. And but I also think that the time people have had out, oftentimes we'd often speak, Paul, and you'd always say that the most interesting time in an advisor's world is probably the first week in January traditionally, and late summer. People have been off for Christmas, they've had to think about things, they come back, they say, right, I want to do it. They go through the summer holidays, they come back, I want to do it. But I think the pandemic has been a long Christmas. You know what I mean? It's allowed people think a lot more about life priorities and work life and business life balance, and the risk. Like I think it's a big message. Like it's like having, like, that's this binary thing of having 100% of outside of your family home, 100% of your wealth in one business is reckless on behalf of your family. And then selling all of that potentially and sitting in all this cash in a negative interest rate world is equally precarious. So like chipping some off and reinvesting that notional amount back into the business, i.e. your own business, is the optimum solution for a lot of people. You know what I mean? And I think people are opening their eyes to that. And also people are saying that beware of the big bad wolf with Mary Lou and co, in the sense that the million at 10% is there today. It might not always be there. So if you sell your first million gain, which will be covered by yourself and John. But your first million gain at 10%, oftentimes people have a husband and wife. There may be siblings in the business, etc. So there's one particular case where we're talking to two siblings who have two wives, and they're looking at taking 4 million off at 10% CGT rate. That may not be there regardless of Mary Lou or anyone else, even the incumbents. There's a bill to be paid for this pandemic. The books have to balance, and they may take that away and see it as low hanging fruit and just have the general CGT at the 33% it's at. So yes, I think the pandemic has given people a lot of time to think. They were worried about deja vu, and there's a definitive kind of certainty to people's plans now. I want to do something.
What recommendations around process would you have for SMEs in preparing to raise capital? And what is the optimal mix of debt equity? Alan, will I go to you on that one?
Yeah, so I suppose, as I mentioned previously, I think, establishing your capital plan, your requirements, and your capital structure with your advisor is definitely the first step on that process, and particularly for a transformational funding decision that taking on private debt or private equity entails. The other point around responsiveness, typically businesses that we speak with, particularly if it's for an acquisition, growth for an acquisition, well then there's a time sensitive case there. So having your financial information up to date, quality of financial information and level and quantum there, and access to management, those are key features to enable a swift process there in getting access, I suppose, getting a decision and ultimately getting funding over the line. So I think those are critical. But when you talk about the right mix of debt or equity, it's easy to the differentiating characteristics between private equity and debt. You can simply say, right, there's the cost of capital, obviously, but usually it's more important than that. It's around the strategic element. And Beachbook at a European fund, we provide senior debt and junior debt to support private equity backed transactions. And where relevant in the Irish market, we'll also advise companies that it might be appropriate to bring in a private equity investor on board who may have that strategic element and to add to the business at that stage. So cost of capital, obviously, if you're dealing with a management team who are very experienced, they're comfortable with executing their business plan themselves, they may seek to use private debt at this stage to execute the business plan, generate additional revenue, and ultimately have a higher valuation, and then potentially sell to a PE firm later on. That's an option. So it's genuinely dependent on a case specific basis, and ultimately it's more important than just the cost of capital. It's about the strategic factor as well. You're on mute there, Paul.
Would you want to comment on that one, Mark?
Yeah, I think, look, I think it's really leaning on your advisor, doing your cash flows and doing worst case analysis, doing your scorecard in advance. What are the non-numeric things you want around the table? But then, like, you can get both right and both wrong, in the sense that, like, you get in debt, say you've got your bank debt, you've got alternative debt, you've got equity. You get in debt and you don't dilute, and it funds your growth, and you deliver your thing, and you look very smart. You don't, and you take on too much debt, and you kind of hamstring yourself, and you don't look smart. Equally in equity, you take in equity and you get sold this value add proposition, and you look back 5 years later and said, I could have done that with debt. You know what I mean? Like that doesn't make you look smart. Or you sit around and you say, fuck, I couldn't have won that game without those people on the pitch with me. You know what I mean? So it's really, really doing the homework, listen to your advisor. There's no right or wrong and it's really thinking it through, looking at the non-numeric things, looking at the numeric things, getting references from previous partners. You wouldn't hire somebody without getting a reference. So get a reference and find out what they were like when the business plan didn't go to plan. Find out what they were like when, you know, what did add value. So it's there's no one answer to that, Paul, but it's kind of think it through and get a good advisor like yourself, you know.
We've seen probably a 60% increase in advisory services and people, you know, getting much more savvy around their numbers and so on. So again, looking at it, a lot of the companies are looking at growth, and they're seeing these times as opportunities again with the unleash of funding that effectively are savings that are there at the moment in the marketplace. What's your view on funding MBOs, both the appetite and the structuring of finance? And do you see a lot of MBOs and mergers happening more to the forefront, where people will start to identify niches in the market? Alan?
Yeah, well, in terms of our appetite for supporting MBOs, you know, we've made 5 investments to date in the Irish Fund since 2019, and 2 of those have been an element of MBO. So we absolutely do support that, because, you know, it's not necessarily the use of funds that drive a decision. You know, you're focused on the underlying fundamental characteristics of the business, you know, strength of revenue, profitability, cash flow conversion. And then you're looking at the market dynamics and the growth opportunity for that business. So they're the elements that dictate our investment decision, not necessarily the use. So in short, absolutely, we would support MBOs, and we have in the Irish Fund.
Mark, do you want a quick comment on that one?
Yeah, no, absolutely. Like we've been, you know, again, of our 5 deals, you know, we've had 2 MBOs. One was a 63-year-old in Mike Flanagan, who was waiting 33 years to MBOs. But I think, like, the MBO from the management side and from the vendor side, like from a vendor side, that takes planning as well, because you got to end up with, you know, if you're the owner of the business and you're trying to get this management team who effectively then presents, there's a lot of work in doing that to get it. But it's when it works right, it's a bit like a family succession. If it's handed over to the kids and they're capable and passionate, it's amazing to see it in play. It's brilliant. And equally, when you see somebody, because the business is generally, it's not all about the money. There's a lot of legacy. There's a DNA to it, and you know that you can trust those guys to take on your legacy, if you like. You know what I mean? Like, so I think it's done right. It's beautiful, and but there's a lot of planning in that from a but it takes the sting out of an exit for a lot of founders, because they're not selling to the enemy trade and they can kind of sell it. But we're backing it. But again, the usual rules apply with a sensible mix of debt and equity, you know. Yeah, and management teams, I just say on caution on that is as well, like, it shouldn't all again be focused on their share, because, you know, if they take too much debt and they hit a bump on the road, then it's kind of, they're constrained within the business. So it gives them more flexibility to potentially to pepper in some equity with the debt, but it's case by case again.
Just one final question. What methods are you using to value firms? Mark?
Look, I think it's, again, case by case, but you kind of start away. You start as there has to be any precedence in the space. Then you look at some PLCs and what are they trading at, and that can kind of say, like, you know, if Smurfit is trading at probably somewhere around 8 times the value of Smurfit. If you were to buy it, is trading about 8 times profit. So if we're looking at a packaging company that's very small and has high customer concentration, you know, we won't be paying 8 times. We might pay 5, 6 times, you know what I mean? And we'll see what else has been done in the space. But again, it depends on, like, our existing businesses. I don't think we bought anything lower than 5 times profit, and we went to near 10 times for one, you know what I mean? But it all depends on, is there recurring revenue? Is there asset backing? What's the growth like? And the multiple on EBITDA is like, what is EBITDA? Sometimes is it next year's, is it this year's? But we're being very flexible on COVID now, and there's a few deals we have where we're laying it out saying, well, you know what, it looks like by the end of 2022, you know, you might have made 2 million last year and 2 million this year, but you should be making 4 million by the end of 2022. So we'll value you on the basis that you're a 4 million profit business, give you a reasonable multiple on that. But if by December 2022, you only deliver 3 million and not 4 million, we might have to recalibrate the shareholding based on that. But you're trying to put yourself now in December 22's position and buy the shares then as well. Like, that's so the value, again, it's how long is a piece of string, but it's and that's where the advisor comes in. But it's case by case.
Alan, do you want the last comment on that one?
Yeah, I suppose, you know, typically from a debt perspective, you know, if for example we're supporting an acquisition or an MBO or shareholder realignment, you can use the valuation based on that basis that's used in that transaction. But alternatively, we look at businesses that are not, where we're not supporting an actual transaction, and similar to Mark, you know, it's looking at comparables in public markets and applying liquidity discounts, etc. But in terms of the EBITDA figure, I agree again with Mark there. You know, it's establishing what that true EBITDA figure is. And, you know, in the last 6 months, sorry, we've made 3 investments on the basis of looking at what a normalized level of EBITDA is, you know, because obviously levels are depressed in the last 12 months. So that has enabled Beachbook to fund growth in 3 SMEs in Ireland in the last 6 months by looking at what a normalized level of EBITDA will be.
Okay. Mark and Alan, thank you very much for participating this morning. It was a pleasure to have you on board, and we'll talk again in the near future.
Thanks, Paul.
Thank you.
Thanks, Alan.
Cheers. We now move on to John Mcinerney. John is a pension technical manager at Aviva Life and Pensions Ireland. Welcome, John.
Good morning, Paul. How's it going?
Very good, thank you. And you?
Never better.
Good man, good man. So you're going to enlighten us in a quick whirlwind on the pension markets, and we look forward to your presentation.
Well, I'm certainly going to try. Paul, you can see my presentation there, okay?
I can, yeah.
Yeah, perfect. Okay, good morning, everyone. My name is John Mcinerney. I'm a pension technical manager with Aviva. So I suppose that's a fancy name for somebody who helps company directors and their advisors extract money out of their company via pension arrangements. I've been doing it about 20 years, would you believe? Look, in the next 20 minutes, I'm going to turn nobody into a pension expert. It's a far bigger subject matter than that. But I'm going to share what I see. What do I see company directors, and how do I see company directors using pension arrangements to extract value out of their company via pension contributions? It's not an advertisement for the pensions industry, and it's certainly not an advertisement for Aviva. I'm not going to mention either of them. And just before I go into the meat of the presentation, I know there are all kinds of different tax planning strategies, and there's retirement relief and entrepreneurial relief. I'm just saying that pensions is probably going to be part of that strategy. So that's what I'm going to cover and I'm going to go through. So my agenda is, where are we now? Go through where we are at the moment, simplify the journey, kind of boil it down to brass tacks. You're going to hear me say using pensions as a cash extraction tool, so apologies for that in advance, but just to explain what I mean by that. And finally, 5 what I would call simple, low-hanging fruit, maybe obvious pension opportunities that are there for company directors to extract money out of your company via pension contributions. So look, for the love of God, don't get too bamboozled by this slide. All I'm trying to demonstrate here is pension legislation came into effect about 50 years ago. And up until 1990, there wasn't a whole lot going on. And then in 1990, the Pensions Authority were set up. Pensions Authority was a state body responsible for the authorization and regulation of pensions. And says he with a smile on his face, wherever you have a state body, you usually have a lot of rules being put in place. And look, there's tax planning rules, there's new products, there's reports, there's no industry in Ireland that has more government reports about it. And here's just a slide demonstrating some of the changes in the near future, or in the recent future. But all I'm trying to demonstrate here, all I'm trying to show is it isn't rocket science, but pension planning can be complicated. It's not for a have-a-go hero. The rules can change as you go along, so you need to make sure whatever pension strategy or plan you have, it continues to be fit for purpose. And take advice, and a few presenters have said this already, take advice, talk to Paul and the team. So I suppose basically what I'm trying to say is you're never too young, you're never too old, you're never too risk averse, it's never too late, it's never too early to look at pensions and making pension contributions to extract money out of your company. Now, I got a bit excited there at the end of that slide, and I said, if you're dead, look, if you're dead, you're dead, and your pension and cash extraction is the least of your problems. So what I'm not going to talk about, because I know it kind of drives you mad and you get fed up talking about it, I'm not going to talk about the state pension. Right, currently we have 5 workers for every 1 retiree. In 30 years' time, we're going to have 2 workers to every 1 retiree. How's that going to work? How's the state pension going to be funded? I'm certainly not going to get involved in the argument over the state pension age. The state pension age, so this is the age at which the state pension becomes payable, was supposed to go up from 66 to 67 this year. It hasn't. It's become a bit of a political football. There's a commission having a look at it, and they're going to report in the future. So I'm not going to get involved in that. And I'm not going to talk about life expectancy and the pensions time bomb. And we're all, you nearly need to feel bad about this, but we're all living too long. We're all too healthy. There's advances in medicine, etc. And if we're all going to be hanging around that long, how are we all going to be paid for in our adulthood? So I'm not going to control all that because we can't control it. And you know that old phrase, control the controllables. I'm going to talk about the controllables. So I said I wasn't going to do an advertising for pensions. And again, I'm not, but just to explain the rules for you and why you might consider using pensions to extract money out of your company is, the first reason is there's tax relief. You can get corporation tax relief on employer contributions that your company pays. And indeed, you can get tax relief yourself for any contributions you make against your own income. Once the contributions are made to a pension fund, the pension fund goes tax-free, subject to salary and service. And look, I'm not dragging you into every pension rule in 20 minutes, but you can build up pension funds up to 2 million. You can take 25% of your fund as a tax-free lump sum when you access it, up to a limit of 200,000. And when you came to the back door, when you wanted to access your pension fund, back in the bad old days, if I could use that phrase, you used to have to purchase an annuity, which basically meant you gave your money to a life company and they paid you an income for life. Now there's products called ARFs and AMARFs, which you control and you can pass on to your next of kin. And I'll talk about that in a second. So current pension rules are generous. And look, at the end of the day, despite my fancy slide presentation and some of my lingo, like ultimately, it's a very simple journey. You're trying to use pension rules, generous revenue rules to extract money out of your company as you go along. So in your latter years, there's funds there to support you. It's no more complicated than that. Now, what are the rules when you get to the back door? And again, I hasten to add, I'm not dragging you down a pension rabbit hole, but let's just look at a fund of 500,000. Somebody has built up a fund of 500,000. They can take the first 25% as a tax-free lump sum, so they get 125,000 as a tax-free lump sum. Now, if they don't have a guaranteed income of 12,700, which is pension income, which most people don't, they must put 63,500 into a product called an AMARF. And what an AMARF is, in my simple language, is a bucket. It's a bucket of money. You control it and you decide what it's invested in. And you can take 4% per annum for it if you want, but you can't go near, the capital, okay, until you're age 75. It's locked away from you until you're age 75. That final bucket beneath there is the ARF bucket. And that's the bucket of money that you control, but you can draw down for it as and when you need it. It is accessible. It is, and that's where your flexibility and choice and your own free will comes into play. Any withdrawals you do take from an AMARF, they are subject to income tax, but if you take them later on in life with income exemptions, you can keep the effective tax rate down. So that's what the journey looks like for a pension arrangement. So what is a pension? And like, I think pensions have a bit of a branding issue, and I've been saying this for a long time. Nobody needs to tell me that the minute you say the word pension, a lot of people get disinterested or turn off. But it is a good tax planning tool, and it is a good cash extraction tool. It's a good way of moving money out of your company and into your own personal name or ownership. Like, we have to be very clear here. Company bank account is not your bank account, and it never will be. Now, part of the mystery, if I could put it that way, of pensions, or one of the reasons that people struggle with pensions, is all the terminology. Forget about the terminology. Think about the rules and think about using the rules. The terminology is just terminology. Leave that to someone like me. So, what is a pension? It can be a cash extraction tool, as I've said already. It can be an estate planning tool. I talked about AMARFs and ARFs, and you can move them to your next of kin. It can be a tax-free lump sum in my pocket tool. I'm going to talk about that in a second, actually. Not have all my eggs in the one basket tool. Having a pension arrangement and funds in that pension arrangement held outside your company, it's a bit of a diversifier. You might be selling your company and it becomes a useful tool. You might have a spouse working in the business. You can pension your spouse. Your children, if they're working in the business. You might be leaving your company and you can get money out of a pension out of your company via an employer contribution pension that way. Or you're trying to get money out of a company before you die, or you need a safety net in case your company ever goes wallop to. Like, again, think of the various things and the various rules and the various ways you can use pensions as much as the phrase itself. Now, the usual objections in people's head is, well, what about retirement relief and entrepreneurial relief and other tax planning opportunities? Yes, they're out there too. I'm not naive to think that they aren't, but pensions can be part of your strategy. Sometimes people say, well, I never want to retire and stop working. That's fine too, and the very best of luck to you. But if you don't stop working in your old age, make sure it's because you want to, rather than you have to, because you never made allowances or put funds aside. My business is my pension. That's a good strategy too, but just be aware, especially at the last crash, a lot of people who thought their businesses would be a pension, their businesses didn't get through. And look, there's people far smarter than me over the next 2 hours talking about where you can invest your money and how you can invest your money and what you can have your money invested in. But most of the opportunities you have on a personal basis, you also have via pension. And look, I hate pensions. That's fine too. That's allowed too. And there are some wars you will not win. Nobody knows that better than me. But again, look at what it can do for you. Look at how you can use the rules to your own benefit. Now, and look, I've used this phrase a few times already, cash extraction and using pension rules to get money out of your company. I just want to put some figures around that, okay? So firstly, we have a very generous Irish pension system. It's much more generous than our neighbours in the UK. You can build up far larger funds and you can make greater contributions. It does give you a planning opportunity. It does allow you to take large amounts of money out of your company and into a pension arrangement in your own name. And a big point as well, that's probably important to a lot of people looking at me here, rather than it is for myself. I'm just a wage slave, and I think we're a bit blasé about it in the life companies, is the scheme is held separately from the company. So it's a pension scheme written under trust, held separately from the company, frankly, you can't go rifling through your pension scheme. It's not a bank account in the bad years, but neither can your creditors. So it is held completely separately from the company. And please don't get bogged down in the figures, because the figures don't matter. I just want to kind of scope out, what do I mean you can make large pension contributions. And you'll just see there NRA 65, that stands for normal retirement age. You have to pick a normal retirement age under pension funds and rules. So you have to pick an NRA. Now, nobody's going to walk into your office and put you under a headlock at age 65 and march you out of the office and tell you have to retire. But you have to pick an age. So if we look at a 40-year-old there, a male, married, what that's trying to tell us there is a married male at 40 years of age could put in 76% of their salary between now and NRA into their pension, and the company could get tax relief. For a female, it's 69%. If you go further up the age, you can see there at age 55, 189%. For a female, it's 173%. On my next slide here, and again, don't get bogged down in the figures. I'm just trying to explain and show you the levels of scope that are there. That's a husband and wife. They're age 50, no pension benefits, 75k salary each. And again, we don't need to get him bogged down in the figures, but you can see there, for him, he could write a single contribution of over 500. So could she. They could write annual contributions for him of nearly 70, for her 85. So that's just to scope out. And just finally on this cash extraction idea, it does give you the ability to extract large amounts from the company. There's nothing compulsory. This is something that people get in their head as well, is, oh, you know, I may not want to pay that level of salary, or I may not want to fund at any particular level. There's nothing compulsory here. Like, there are only plans or strategies. Like, companies have good years and bad years and ups and downs. And maybe they need company money for other things rather than pension funds. There's nothing compulsory here. As I said to you, there's nothing set in stone. You know, phrases like normal retirement age. As I said to you earlier, nobody's going to walk into your office and get you in a headlock and pull you out of your business at 65 because that's the NRA on your scheme. There's nothing set in stone. And the final thing I would just say, and again, this is being from sitting in my seat so long, like, start now. Like, don't think you're too young to consider pension funding. Like, the pension, if you're thinking of retiring at 60 or 65, the pension contribution that you pay in your 40s, you know, if you're thinking of going at 60, will work 15, 20 times harder because it's been invested for 15 or 20 years longer than the pension contribution that your company would pay for you at the end. So you know, so consider it earlier on. The second little seed I'm trying to plant, and again in 20 minutes I can only plant a few seeds, but it's just this issue of spousal employment, and it's a very easy one to get your head around. So this is for either company directors or indeed self-employed people, is if you're hiring your spouse and your spouse is taking a salary and it's a bona fide employment, that salary can also be pensioned. So if you're paying your spouse a salary, you also have the opportunity to pension fund and do a lot of what I spoke about there. So kind of the little seed I would just plant is, like, it's you get two cuts at it, if you know what I mean. You can do it for yourself and for your spouse. One other little issue I always like to talk about is, and look, I'm conscious some company directors, they maybe have other companies or other forms of income, or maybe are trying to keep their incomes down, so in order not to pay too much income tax. But if you ever do come to someone like me, or if you ever do look at pensions as a way of getting money out of your company, one of the questions someone like me is, well, how much service do you have? And the more service you have, the greater scope you have. And the issue is that you can only count a year's service if you take a year's salary. Now, a lot of people say to me, oh, John, I don't want to take a salary of 50,000. You know, I don't even pay the income tax. I'm not saying take a salary at that level. I'm saying just take some level of nominal salary, just to keep, from a pension perspective and for the purposes of the calculations and for the purposes of extracting money out of a company via pension at a later date, just to keep your service ticking over. Now, this is the third little seed that I just want to plant. And I'm not dragging you into pension rules, as I said. This is called a salary and service rule. This is and by the way, anything I talk about here, it's not X-rated or dodgy at all. Anyone who wants a magical mystery tour through the Revenue Pensions Manual, which shows that all this is written down, no problem. But so the general salary and service rule is if you've 20 years service and you get to NRA and you've never had a pension, under the salary and service calculation, you can have 1.5 times your final remuneration as a lump sum. Now, for a company director, that final remuneration is a 3-year average. But again, that's just rules. So what am I saying is, I'm saying if you got to 65 with a final remuneration of 100,000 and 20 years service, and you'd never done any pension funding at all, the company could write a check to a scheme for you for 150,000. Now, I got a little bit excited and said, and the life company or the scheme would pay you out 150,000 tomorrow. It wouldn't be, because the scheme has to get revenue approved. But if you think about it, you take 150,000 out of the company, you put it into a scheme, and under the salary and service calculation, you pay it out to yourself as a lump sum. And like I would always argue is that that is nearly the basic pension planning or pension idea you should be having. Now, I'm always guilty as well as using figures, a salary of 100,000. Let's say you had a salary of 50, 1.5 times 50 is 75 grand. Let's say you had a salary of 20, 1.5 times 20 is 30 grand. And even I talked about 20 years. If you've got less years, there's still an opportunity to use the salary and service calculation. So that's the third little seed I'm trying to plant. The final two, and I'm conscious I'm talking against myself a little bit here, but I'm going to say it anyways. And earlier I talked about, getting involved in pension funding, and like it's never too early, and start and build up your funds over a long period of time. But it's actually never too late. Even if you're coming out of a company next year, or you're deciding to retire, you're deciding to sell, or whatever the case may be, even and I mean up into your 60s, 70s, and indeed even beyond, if you've never taken advantage of pensions, if you've never made a pension contribution, if you've made modest pension contributions, for want of a better phrase, you can catch up at the end. So I suppose the other little seed I'm trying to plant is, if you haven't maybe considered this before, or you think I'm too old now to be thinking about pensions and that kind of things, or I've left it too late, you probably haven't. This is just an example of one individual, and he was restructuring his business, and don't worry about manipulating salaries, and he had built up a modest fund. And what we did is he made and again, I'm not driving this, his advisors were driving this. He made a contribution to bring his fund up to 800,000. So again, the seed I'm just trying to plant there is even at the very end, there can be an opportunity. And just my final little seed just to plant is just on company sales. Company sales, there can be a pension angle, and again, I'm not driving it. I'm the person who takes the phone call or gets the email and is asked to produce the figures. But if you're selling your company, and if you have a cash-rich company and there's a lot of money in the bank account, the tax advisors involved or the advisors involved will invariably say, look, we need to try to get the amount of money in your bank account down, because whoever's being bought doesn't want to buy a company with, it ups the price of the company, and CGT and stamp duty issues and all that. But one of the quickest, easiest, fastest ways of getting money out of a company bank account very quickly on a company sale is making a large employer contribution to a pension scheme. So I think I have a little example there, just a worked example. This was a company sale, cash-rich company, a husband and wife. Don't worry that they'd already retired their pension schemes. That's just a bit of background. But we went to revenue, and they managed to get $1 million out for him and 500,000 for her. And if I'm being honest with you, it had nothing to do with a great love of pension funding. It just had to do with the underlying strategy to extract money out of a pension fund. So just to conclude, and Paul, I see you coming online there. Don't worry, I was going to outstay me welcome. Consider pensions. There are very generous rules there. It should be part of your planning strategy. Start, have a think about it. Forget about the world of pensions and all the different acronyms. We're a terrible industry for acronyms, and forget all the noise that's out there. And finally, get advice. Talk to the experts. Talk to Paul and his team. Like I've demonstrated there, none of it is rocket science, but there are rules. The rules do change. Maybe a pension strategy that worked and made common sense 5 years ago, maybe it needs to be tweaked now. And look, with anything like this, talk to the experts and don't be a have-a-go hero. And without further ado, before you butt in, Paul, and I think I'm just about the 20 minutes, I'll hand back to yourself for any questions or comments. You're on mute there, Paul.
So thanks, John. That was very informative. A couple of questions coming in from the floor. What do you recommend for levels of risk pensions are invested in latter years? Is it all put in cash and safe? And when it comes to the ARF, what level of risks are people taking?
Yeah, well, I suppose the issue with by the way, I hasten to add, there's people talking before and after me that can talk far better about investments than me, but it's very much down to the individuals. Like what I might think is an acceptable level of risk, for one person, they mightn't necessarily agree. Like for longer term pension funding, like if you're a 40, 45, 50-year-old and you've got 15 or 20 years, they're going into more equity and high equity content funds. For somebody maybe approaching accessing their pension funds, or indeed they've retired out into the ARF and the AMARF, they might dial down the risk. But what I would say about risk, Paul, is ultimately whatever risk profile you're in, there's a fund or a strategy there for you. Like if you want to go all equities, you can do that through a pension, and if you wanted to go all cash, you can do that through pensions. It's up to you. It's up to you.
Another one coming in, a gap in service. Are the earlier years of service counted, or do they have to be continuous?
You'll get different views on that, Paul. And one of the issues with pensions is, and I talked about the pensions manual there in my presentation. There's a lot of things not covered in the manual, so you get a lot of interpretations. But in my view, and the view we take at Aviva, is you can count any service as long as there's a salary paid in that particular year, and we would count it as continuous service across the divide, for want of a better phrase.
And finally, John, just in relation to there's a talk about increasing taxes to pay for the pandemic. Do you think that the government could take a view to reduce the 2 million back to 1 million? And if you were in your early 50s now, would you think you should consider drawing your pension and taking the 25% and setting up the ARF?
Ultimately, I don't know the answer to that, and I have no secret in or have access to any more information than what you have. My own personally held view is the 2 million is going to hold, and I can't see them reducing the 2 million. When I say them, don't forget the 2 million applies to everyone in the private sector. It's also a limit for the public sector as well. And I don't mean to be a smart aleck here, but the 2 million figure suits public sector workers and high-level public sector workers as much as it suits us in the private sector. And I would also point out at the moment that ISME have actually launched a how would I put this, a war chest, for want of a better phrase, and a crowdfunding idea to see if they can build up a war chest and actually challenge the 2 million and see if they can get it higher. So let's look at this positive rather than see it falling. We might see it go up. But sorry, to answer your question in a word, Paul, and it's only personally held view, I don't think the 2 million will come down.
Okay, John, thank you very much for your time this morning. Very much appreciated. Thank you, John. Finally, saving the best wine till last, we have John Finn, Managing Director of Treasury Solutions. John has been a great talker at our conferences over the years. I think this is our 5th or 6th conference together, John. So I'm delighted to welcome you back, and thanks very much for participating.
Thanks, Paul. Can you hear me okay? Yeah.
Yeah.
I'm just waiting for John to exit out of his presentation because I have a couple of slides I want to go through as well. And
1 second there, apologies.
No, all right, John, there's no problem. It's funny, the first one we spoke on, Paul, was 5 years ago. It was pre the Brexit vote, if you recall, the end of January 2016. And it was a very different world then, certainly in the currency markets. I think at the time,
Absolutely.
we were, I think it was at 73p. For anyone who's exporting to the UK, you can only cry when you hear those rates compared to where we are today. But I think the call at the time was that it was likely to move to, I think I said at the time it would go to 80p by June. And I think that, here we go now. Hopefully this will work. And it did actually, it hit 80p, I think, by March in the end, Paul. So
yeah.
Now, can you see my screen okay?
Yes, we can. Yeah.
I'll just put it on. Okay, right, here we go. So thanks, Paul. I'm going to try and fly through this. So I'm going to cover interest rates, exchange rates, some banking trends, and then a couple of suggestions at the end. And actual fact, a lot of this is neatly bringing around a lot of the themes. And it's funny, as you know, we don't, the participants, we don't coordinate what we're going to say, but all 4 of Jim's themes, for example, will come up to varying degrees in what I'm going to say. So as I said, it kind of dovetails quite nicely. So starting on the interest rate curves, and this is just giving you an idea of where different rates are at the minute. And if you can see, basically the euro interest rate curve is negative almost out to 10 years. So in other words, these are market rates now, by the way. These are pre-margins, but these are the rates, cost of funds, if you want to call them, for in a lot of cases. And short-term rates, as you know, are minus 0.55%. In theory, fixing for 3 years will be at minus 0.45. And you can see that the 10-year swap rate is actually just barely above 0. In the UK, the rates are higher, and that's been consistently the view. Short-term rates haven't managed to fall below 0 at any stage, and I don't think they're going to at this stage. But the last column there I put in is just Irish government gilts, and you can see that they're quite negative as well. And really, to summarize, in many respects, you know, the negative interest rates that we've spoken about, they haven't filtered through to borrowers, really. So we all know that if your cost of funds on all your banking agreements is floored at 0. In other words, they don't give you the benefit of negative Euribor. That's across the board. I mean, I've seen loans of 100 million, 200 million. They're still having to comply with that sort of arrangement. So borrowers really haven't benefited from it. And of course, depositors are increasingly been hit by it. Larger corporates were hit by negative rates on deposits, I'd say, as far back as 2 years ago. And we're seeing it now trickle down. So really, the main beneficiaries, I'd say, so far have been governments. And I'll talk about that in a second. So if you can see these 2 slides here. So these are it's 3-month Euribor. So what I want to show on the left-hand side there is that's the 10-year trend. So, and even at that, over the last 10 years, the 3-month rate hasn't been any higher than about 1.5%. Now, for those of us who are old enough, you know, 1.5% 10 years ago would have been seen as phenomenally low. I was actually on a call yesterday with a CFO of one of the clients who was telling me when he was a junior in a practice up the country in the early 90s, one of his jobs was to put money actually on deposit for customers. Things have moved a long way in the regulatory front, Paul, too. And he was putting money on deposits in the currency crisis at 25-30%. So we've really had an inordinately low level of interest rates now for quite some time. And the graph on the right really is just is it over the last 6 months. So you can see it's kind of bottomed out. The 3-month rate has bottomed out around December, January, has risen slightly. But when I say risen slightly, it's risen off an all-time low of minus 0.55 and hasn't crept up much farther than that. If we move to longer term rates, which is the 3-year swap rate, and again, don't worry about the terminology. Basically, this is just the cost of fixing money for 3 years if you are in the, for banks, for borrowing for 3 years. And again, we can see at the start of the crisis, rates, were up at 5.5% or thereabouts, steadily falling, and the white line across is 0. So basically, rates have been negative for the most part since 2016, longer term rates. And again, that's when I printed that off the last day or two, is still at minus 0.47. Now, the other thing to note about this is that when you have short-term rates, 3-month rates, and medium-term rates like 3 rates, almost the same, that tends to suggest that interest rates are not moving anywhere quickly in the short term, because obviously 3-year rates look out 3 years, whereas 3-month rates only look out 3 months. And so if you have a 3-year rate at negative 47 basis points, that would suggest that that they're not going anywhere. I'm going to just go to sterling rates for a second, and then I'm going to talk about where these might go, and also the topic of inflation, because Jim spoke about inflation, and I think it's actually very relevant in the current context. So if we look at sterling rates, so, and again, I'm just putting it in case some of the clients might have some borrowings in the UK, and indeed a lot of Irish companies have activities in the UK. You can see, first of all, their short-term rates, their LIBOR rate has been not quite as, it hasn't fallen as low as we have seen it in Europe, but also has been a little more bumpy, a bit more lumpy, because I guess, their economic outlook maybe for a while was, has varied over the years to be maybe better than some points in the Eurozone. And the same on the 3-year swap rate. You can see it's yes, it's come down, but we've had periods of I suppose rising and falling. And I guess this really brings us to where are interest rates going and what's happening. Now, what I've actually done here is I've put in 2 slides. One on the left is Irish 10-year gilts. So in other words, these are the rates at which the government can borrow, the Irish government. And then on the right-hand side, we've got the US 10-year gilts. I was actually, believe it or not, on a call at 8 o'clock this morning on a webinar from London for 45 minutes where the topic was inflation, because that's how interesting my life is, Paul. That's what I do in my spare time. And the general consensus was that the US is certainly farther ahead than the EU in particular, and the UK in terms of inflationary prospects. And that is reflected already in the fact that, as you can see there, that we're looking at Irish government 10-year rates of just over 0, whereas the US is already well over 1% and has risen quite dramatically over the last couple of quarters. So the consensus view on the States is that inflation will rise. It will rise reasonably quickly in the next maybe 12 months, but probably will abate a little bit after that. And there are a couple of drivers of that. First of all, you've got huge government stimulus in the States, massive. I mean, they had a stimulus pre-year end of I think it was 800 or 900 billion. Biden announced, an even larger 1.7, 1.8 trillion, and they're talking about an infrastructure spend of maybe 3 or 4 trillion on top of that again, which is huge spend. And that tends to be inflationary. And even on the webinar earlier this morning, they were saying that, and as we know here, different pockets of the economy have been hit very differently. So anybody in hospitality, hotels, that have been hit very, very hard, and unemployment has been basically very high in that space. A lot of other parts of the economy haven't been hit at all, and some have even thrived. So that's consistent in the States as well. And they reckon 90% of the sectors in the US actually have labor that's tight enough. So when you get tight labor markets in certain sectors, it tends to drive wages up, and when it drives wages up, you get inflationary pressure. Demographics, I think, will also drive inflation up maybe a little bit in the medium term. And the topic that Jim mentioned of deglobalization, again, probably likely to push inflation up a little bit, because you're going to see, because of what's happening in China, and the US-China trade has not gone well. The Chinese have reacted to the Australians, and they have cut back on a lot of exports from Australia. And there's a growing debate in the UK as to whether they get closer or not with China as well. So you can see more deglobalization, which could be good for us, as Jim already mentioned, but you would expect that might lead to a certain level of inflation as well. So what am I saying in total there? I think in total what we're saying is that inflation is more likely to be stronger in the States than it will be in Europe, in the Eurozone, because the Eurozone has also not experienced the same level of wage growth and disposable income growth compared to the States. So the feeling is that in Europe, it might creep up to the 2%, but probably ease back again next year. Because we see it with oil prices. Oil prices were negative 12 months ago. They hit $70 a barrel in the last few weeks. They're back to about 57, 58. So logically, you're going to get inflation because of energy prices alone. Equally logically, as 12 months rolls out and rates ease off a bit, or energy prices come down or flatten, that falls out of the stats. So the sense is that the US government yields there could rise to maybe 2.25% this year. Which is significantly higher than here. We don't see the same level of hike at all in gilt yields here. So that in turn would suggest that you're more likely to see interest rates rise in the States than you are in the Eurozone. And right now, so I think the suggestion in summary on interest rates is that they're probably fairly benign for now. A lot depends on how quickly the inflation rates go, or more importantly, if they're sustained. I think they will rise in the next 6 months. There's no doubt about it as we spend more and we come out of the pandemic. It's the question really is can it be sustained? And the worry, of course, is that, you know, we had periods in the 1970s where, you know, inflation began to rise. Central banks had the tools to actually deal with inflation then. They didn't for political reasons. And you know what happened subsequently. We had massive inflation at the end of the 70s and into the 80s, which of course drove interest rates very high. So what I would say to borrowers in general is probably be, I wouldn't say you have to do anything yet, probably maybe keep a little bit more of an eye on it than you would have done 12 months ago maybe. And I'll actually just summarize that in a second. I want to show one last graph here. And I know, don't worry about the detail in it. What I'm trying to show you is the orange stacked columns there. That's the level of government debt that the Irish government has. And that's the maturity profile of it going out from this year, from your left to right. You know, each stack there and this year, next year is about close to 10 billion. So we've got a huge amount of debt at Irish government level. The big lump, if I can put it that way, out at the very end means that NTMA has been pushing a lot of it out farther and farther. So that's good news. But, you know, as been referenced in previous presentations already, the pandemic will have to be paid for. The good news for the government is it was borrowing at 5.5% a number of years ago. Post the last crisis, it's borrowing at zero and has been borrowing at zero and below it for the last while. So they've got a really, they've benefited hugely from it. The annual interest bill was about 7 to 8 billion at its peak there. It's probably going to fall to 2-3 billion in the next while. So as I said to you, I think they're the biggest beneficiaries. In summary then, market rates have been exceptionally low for exceptionally long. The thing you got to watch here then is small moves can have a very material impact in relative terms. So for example, if you have a cost of funds of 0 today and a margin of 3%, your all-in cost of borrowing is 3%. If the cost of funds moves from 0 to 1, that's not a very big hike, but your interest cost goes from 3% to 4%. That's a 1/3 increase in your interest bill. So we've got to be alert to this space when we think rates are going to rise. So that's why I'm saying I would move it from do nothing to move it to a let's keep an eye on it now for 2021. Bank margins obviously become the key focus still in terms of your overall cost of interest. And then, you know, the danger there, of course, is that margins could increase if there's no competition. And I'll talk about that in the third section. The impact of negative rates on deposits has clearly been felt. It's a problem now. And but there's no easy solution, I guess, unfortunately, if you're in a net cash position. And then what's the impact on spending and mortgages as well? Let's wait and see. I think the key thing here is that we will see a rise in inflation this year, but in the Eurozone, I don't see it having a sustained impact on interest rates, at least in the short term. Moving on then to the currency. This is the graph really since Brexit. The low point on the left-hand side is where it was when we spoke, Paul, 5 years ago, 72, 73 pence or thereabouts. It's been in that quite a wide channel for the last while, and obviously it really depended on basically how the Brexit negotiations were going. So one way or the other, we got it out of the way at the end of the year. It was a softer rather than a harder Brexit. And as a result of that, we see that trend pretty much over the last 6 months as the market priced in the prospects of some sort of deal being done. Sterling has strengthened. And I think, again, over the last while, Paul, I've been on the record for quite some time, really. I've been saying, you know, hard deal would have seen 95 to parity. A decent deal at all would see it back to 85. And that was the range I was calling. It hasn't quite hit 85 in the last couple of weeks. It hit about 85.50. It's bounced back off it a little bit at the minute. So I'd expect it to consolidate for a while. The only reason why I think it might go lower, in other words, stronger sterling, is the vaccination rate in the UK is so much faster than in the Eurozone. And that would suggest they should get out of the pandemic more quickly. That means people will start spending money more quickly in the UK than compared to the Eurozone. That would mean their economic indicators will get better before the Eurozone. And logically, that might give it a push. So I'm saying for now, while I think the range around 85, 86 should hold, I would probably see it more probable that it might hit 84 rather than 88 in the next while because of that relative speed of opening up in the UK relative to here. And just one other table I'm going to put up here. And this is when you look back over the last 20 years, it's 20 years since we joined the euro. And I try always put up one or two graphs that are maybe telling in their own right. If you focus on the third column there under average, that's basically taken 1 million sterling at the average rate for the year, the average euro sterling rate for the year since 2000. And basically what you can see is if you were selling £1 million worth of stuff into the UK in 2000, you were getting about 1.64 million of euros for that. Last year, you were getting 1.12 million. So there's been a gradual depreciation of sterling against the euro over the last 20 years, which in theory should give them a huge benefit, you know, because it means that it's cheaper for them to export. And I think a lot of that has been lost, maybe a little bit to inflation, but more importantly to a lack of productivity. But the point I'm making here in this, if you look over the last 20 years, anybody who's been selling consistently in the UK, doing business in the UK has become increasingly less profitable, very materially less profitable on currencies alone. Now, that would also suggest that maybe Irish companies have adapted and become more nimble at dealing with this sort of stuff. But what I'm saying, I guess, really in the sterling space, really is, you do have to manage it because it's been on a steadily deteriorating or I suppose weakening trend more or less for the last 20 years. If I look at the dollar very quickly, relatively speaking, it's been reasonably stable over the last number of years. Traditionally, euro dollar would have had a 15% gap between the high and low every year, and that's narrowed. And you can see, you know, it was a narrowing trend there for quite some time. We've hit the top of it again in the recent while. So where it's going is hard to call. My instinct right now, and I wouldn't be betting on it. So again, these are only my opinions, and I have to do the disclaimer here. You know, there are opinions. If you want to do something in this space, you need to be a bit more scientific and talk to your advisors about it. But if I was asked to make a call, I would say to you that I think the interest rate differentials in gilts between US government gilts and Europe is going to widen in the next while. I think that will, and I think the economy is going to do well. I think on balance, I would expect maybe dollar to strengthen a little bit again over the course of this year, which will be good news for exporters, not so good for importers. So if you're importing stuff from the States, you might want to stay alert to it. So in summary, I would say the Brexit bullet was dodged. Companies were not, certainly on the currency front, they really weren't ready. It's probably been, from my perspective on the Treasury side, the most disappointing aspect is that it certainly pushed currency into the limelight. But I would say the management of currency is still, in general, quite poor, because not enough policies or strategies. And the problem with it, of course, as I said, everyone is a genius in hindsight, and that's a real challenge. So what I'm saying to people, particularly if you're thinking of moving into new territories, consider the currency. And lastly, I just leave you to think about is how long before lenders begin to price poor currency management, foreign exchange management into lending. I think it's been largely ignored by lenders up to now. I can't see that continuing. I think that poor currency management is going to will hold companies back or could increase their margins in the next while. Banking trends then, I'm just looking at my watch here, Paul. I think I'm going okay. In a macro sense, we've got the problem is, what are the problems? Impact of consolidation. So we've seen Ulster Bank pull away from the market. That's not good, because in the SME sector, you generally have less choice than in the corporate sector, because there are certain banks who will operate in the corporate sector that won't operate in the SME business banking, and I would call business banking 2 to 10 million loan size. So Ulster Bank pulling out, not a good sign. Less competition. PTSB hoping to fill the gap. I think how quickly they fill that gap will be very important from the conventional bank sense. And the challenge there will be resourcing, because they can buy a loan book from Ulster Bank and gear up on that side very quickly, but they'll need people to back it up. That being said, I think their plans are serious in that space, and I think the government is aware that they need to have a third bank active in this space. And that's not to take away from the non-bank lenders. We've already had a presentation this morning and a contribution from Alan on the non-bank side. The non-bank side is growing, and has grown already over the 4 to 5 years. And it has been niche. So you get it in the asset finance space, maybe in invoice discounting, or in the private debt, which is what Alan was talking about. I don't see that getting any smaller. I'd agree with him that I think it's going to rise over time. And the problem for that, of course, is that the banks are beginning to see, the conventional banks are beginning to see their market being eaten away in a number of different places now. So it's happening in lending, it's happening in currencies, it's happening in invoice discounting and asset finance. And of course, then, the digital banking side on the retail is a challenge too, because a lot of the players who are coming in there, their apps and stuff are just slicker. So it's a big challenge. And in actual fact, I would go so far as to say I think there's a need at government level to really look at banking and SMEs and how it's going to run over the next 10 years, because you need a functioning banking system and financial services system across the board for excuse me, for the SME sector to thrive. And the SME sector here in Ireland is very important, not just from an employment perspective, but particularly from a regional development. And as we move and push more out of Dublin down to the regions, its significance is huge in economic and social economic terms. So I think it's time for it. SME pricing in general here is above the EU average, as we know. And that becomes a disadvantage competitively too. But the other problem is borrowing levels in general are also low. And I'm going to show you just a slide on that in a second. And that has a knock-on effect as well, because basically what happens if the banks need to lend to make money, if they're not lending enough, they make less money. And of course, if they make less money, then their costs have to be adjusted. So one of the reasons why you're seeing the two main banks looking for their redundancies of 1,500 plus apiece is because their cost base is too high relative to their revenue base and their lending base. So, and a lot of that, the decrease in borrowing is confidence driven too, no doubt about it. I mean, I've just seen it consistently over the last number of years, and I've said it before. One of the single biggest problems that came out of the last crisis was not just the level of borrowings people had, but the knock on confidence that the sale of loans to vulture funds had. And even for companies and individuals, and I know at both a company and individual level, where they will grow as fast as they can fund it themselves, and they're very reluctant to borrow more. And that's not always the best option either. I mean, there's a level of investment that companies need in order to grow, and you can't really stay still in business, as we all know. You either grow or you reverse, but it's very hard to tread water. So I would say that the knock-on confidence as a result of particularly that vulture fund thing has been it's held back seriously the level of investment, I think, by a lot of Irish companies. Lenders generally, we've covered this earlier on, emphasis remains on cash flow lending. They'll take security if it's there. Cash flow is king. You got to understand what drives your cash. You got to be on top of it. You got to be able to forecast it out 3 years. And I would say my experience in this space over the last 2 or 3 years in particular, having done a fair bit of work with both Enterprise Ireland and that, is that lending, I see it in a lot of the, what I'd say good sized medium firms, revenue 5 up to 20 million. They fund as they need to, or they fund because it's needed next month or in 3 months' time. They don't look at it as something that's strategically important. That attitude has to change. Because the funny thing about lending is you can future-proof it. You can put funding in place that will carry you through the next 5 years. But it seems to be reactive rather than proactive. And I think that's one of the things that's going to have to change. And it's also one of the success factors for a lot of SMEs in particular, the ones that thrive versus the ones that don't. They're thinking about the future and they're positioning their financing to facilitate them. And banks will talk to you about it, and lenders will talk to you about it, and private equity funds will clearly are there to talk to you about it. That's the sort of firms they want. So companies are going to have to prioritize this a little bit more. On the lender side, we can see, and again, this has been referenced earlier in the conversations, that there's a lot of automation and systemization of processes. And again, that's been driven by cost. The more that you can put the numbers into a computer program or into an Excel spreadsheet, and the less interaction you have with people, the easier it is. That's the theory. My problem with that is that lending is part art, but it's part science. And anybody who's been involved in lending knows that. You lend, particularly at the SME level, as much to the individual as the business. In other words, is that individual, do they know their business? Do they know their markets? Do they know their products? Are they the people to drive it? Are these the people that work 60, 70 hours a week, which most businesses are? A computer won't tell you that. And I would worry about that part of it, because you need more people to lend in business banking than you do in corporate banking. I mean, you could probably run a portfolio as a lender in corporate banking. You might run a portfolio of 300 or 400 million and have only 20 clients. You won't run a portfolio of 300 or 400 million in the SMEs sector with 20 clients. You'll have 200 clients. And that is going to be the challenge. It's going to be the challenge. And that's why I'd worry about the impact of voluntary redundancies in this area in the banks. There are certain parts of the bank maybe that they just have to let people go. There are other parts, Paul, that are going to suffer. And this is just a second last graph there, which is basically showing you how Irish bank lending has gone since 2003. This is the level of lending to what they call non-financial corporates, companies, since 2003. And you can see we are now below 2003 levels. That's how much it's fallen since the peak. The peak there was over 165 billion. 167 billion in 08, and it's down to about 38 billion at the minute. So in summary, what I'm suggesting really is knowledge is power in this space, but also competitive edge. So get up to speed, particularly on the funding, the banking, the importance of that. Stay alert to the interest rates, especially if inflation re-emerges. I think, the markets, as I said, are unclear about future steering direction, but I've given you my view on where I think both might go in the short term. But I do think you need to start putting strategies in place. I think it's important to focus on the quality of your borrowing relationship. In other words, work on the relationship bit. I don't care whether it's a bank or a non-bank. The relationship bit's important. And treat finance as a strategic imperative. And I suppose the last thing, two last things I would say is, for CFOs, and finance directors, don't leave yourself exposed. Put basic risk policies in place for your board, because you are responsible for risk. The board is responsible for risk, I should say. But if you don't have a policy in place, your head is on the block. And watch this ESG space. Jim referenced it earlier. ESG, again, economic, social, and governance. There's a real emphasis on this. It's not going away. It's going to impact on everything that we do. It's going to impact on borrowing. It's going to become factors for borrowing. Banks will want to see more and more of this. It's going to become a factor in our products and our services. People will look for companies that are more committed to green initiatives and all that sort of stuff. And I'll finish on this. And it is interesting to see. It's the speed with which things are going. I've got 4 kids. My youngest is 18. My eldest is 29. The 29-year-old is working in tech in Vancouver, and they're trying to figure out, she's a product marketing manager, and they're trying to figure out the attitudes of the 18, 19, 20-year-olds to products, because that generation gap, 10 years, is already huge. They don't understand them. And I don't get the 29-year-old, the speed at which things are moving and people's expectations, particularly in the services space, is massive. And but this ESG is one of the key, is important, it seems, to a lot of the younger ones. So it's not just going to be theoretical, it's going to have practical ramifications. That's it, Paul. Sorry, that's as fast as I could be. I think it was okay, was it?
Thanks, John. Excellent presentation. Very, very informative as usual. And thanks very much for presenting. 2 quick questions before we finish. How seriously can institutions take the cash flows and the supports that you're going to put together, bearing in mind the COVID situation that we've just had? And how do companies mitigate against that situation going forward?
Do you mean, how do they treat the fact that, they've taken wage subsidies and all that sort of stuff? Is it?
Wage subsidies and nosedives in their, I suppose, their turnover and their projections, and the impact that it has had. And where do you see, that leveling out, that again, looking at the projections, do they go back to 2019 and think that they can get to that level again in 2022? Or what's your view on it?
Yeah, first of all, it depends on the sector, as you know yourself, because some sectors are flying, others are not. I mean, it's a huge challenge, for example, if you're in hospitality or hotels. I mean, you can't forecast right now, because until you know when we open up and how we open up, it's impossible. And I think in that space, there's a wait and see. Quite frankly, I don't see it changing. It's for the others, I would generally say, there's a sense that it'll be at least 22 before you're back to 2019 levels. So, if you're going to forecast getting back to it quicker than that, or you're going to forecast, getting beyond 2019 levels very quickly, I think you'd want to have a good basis first. You want to be clear that it makes sense in the context of your sector. One of the things they will watch out for is to the extent you might have warehoused some taxes, because clearly if you've warehoused taxes, that has to be repaid. So they would almost treat that as debt right now. So I think people would want to be aware of that fact. It'll be factored in for sure. I think talking to other firms and clients, the subsidies generally have helped hugely. And in some cases, the companies are sitting on quite a lot of cash, partially due to the subsidies, but they will need it as things unwind, and as they ramp up again. But really, what I would say to you in general in the banks is that it gets back to sensible projections, making sure you go out 3 years, making sure you understand the detail. Like, they will query in more, and you know this yourself because you're doing it with your clients the whole time. What you're projecting must make sense. They're looking for better quality information farther down the line now. So it's not just sort of say, here's my sales. They want my sales by margin, or sales by product, or sales by region, whatever. They'll want gross margin detail. They'll want to drill into the overheads more. So I would say that they're going to demand more granular information in that SME level. That's not necessarily a bad thing, because I think you should know it as a business anyway. And if you don't, you need to get up to speed and use your advisor to get you up to speed. And look, they have to lend. This is the dilemma they have. I mean, if they say no to every loan, they don't lend. If they don't lend, they don't make money. So for now, I would say that I've seen them generally to be fine. This is not a trite thing to say, but I found it is hugely important. Years ago, I spoke to a head of retail in one of the banks, and he said there's no such thing as a good and a bad bank, but there is such a thing as a good and a bad banker. And my experience over the last while is that it's essential to try and identify the people in the banks that are the right people to go to. There are just some people who get stuff done quicker than others. And that's just the way it is. And that sounds, I mean, I know people might listen and say that there's no science to that. I'm telling you, it is hugely important. It can be the difference between getting what you want and getting or not getting what you want. And that comes back to having your preparation right, presenting decent figures, and I suppose, working with an advisor that kind of can probably guide people in that space too. I mean, we've spoken earlier on in some of the presentations about the added value, and Mark would have talked about it. But the added value as an advisor sometimes is that's knowing the right person and approaching it the right way. There's huge added value in that, Paul, because that can be the difference between success and failure.
It's great, John. Thank you very much for attending again today. Really
My pleasure, Paul. Thank you as ever for inviting me.
Thank you. So that concludes our conference for this morning. I'd like to thank everybody for attending it. I just want to say a few thank yous. Again, such an event, there's a huge amount behind the scenes that goes on in all these type of events. So sincere thanks to Jackie Walsh and Raheem Juma from the office here, who put a huge amount of work involved in it, to Fiona Collins for hosting it. And then just one other final thing, we've relaunched our website, and huge amount of work has gone into that again, both by Jackie and Raheem, but also thanks to Cy Warren, Orla Clancy, Anne-Marie O'Sullivan and Cy O'Sullivan for their input into all of that. And the website is currently going to go live, and we look forward to people looking into that, and again looking at the advisory services that we're continuing to push out in Paul O'Donovan and Associates, and we look forward to teaming up with you throughout the 2021 season. Thank you very much, and goodbye and thanks.